Welcome into the Owner to Owner podcast. Graham Stephen from Bizval Global joins me today. Big welcome, Graham.
Michael, wonderful to be here. And as you can hear by the accent, we won't talk about cricket today, but yeah, thanks for having me.
No, that's ancient history, and it's always about moving forward, Graham. The accent, but you're based out of the UK with Bizval Global, even though it's an
Well, yeah,
emerging
we've
global
got we've
business.
got three main offices out of Cape Town, South Africa, out of the UK, and then also out of Austin, Texas. So we're kind of spanning three continents. A little bit of business in Australia, but the time zone always makes that pretty tricky.
Yeah. Excellent. Well, look, you're the founder of bizvalglobal.com. Fast, accurate answers on what your business is worth is one of the, not the tagline, but I think your purpose as a business. Do you want to give us a little bit about your pathway into Bizval Global? For today, I think we're going to cover some really interesting ground. Business valuations for a lot of business owners are, I think, a one-off thing. They tend to be, I'm getting my business value because I want to sell the business, and I may never have had it valued before. Occasionally, people use it because they've got a partnership dispute or there's a settlement, matrimonial things. So it's not familiar ground with a lot of owners, but we're going to talk about why owners should think about a regular valuation and what you get from it. I think we'll also talk about a couple of things, what your learnings from running a global business and how that is relevant for Australian SME owners. And also, I think mainly the flow on, if you do understand the market value of the business, we'll use market value, what that can help you with day to day. So some pretty important themes. Graham, do you just want to give us a couple of minutes on your background, pathway into Bizval Global, then we'll get stuck right into the nitty gritty.
Fantastic, thanks, Mike. I'm a bit of an accidental entrepreneur. The backstory to this is my dad is what I call a failed entrepreneur. He got laid off in his early 40s. He was an artisan by trade, a millwright, worked in an industrial city, and when Ford Motor Company pulled out, all the ancillary industry and around that effectively collapsed. So he became, I guess, self-employed in his early 40s. And to this day, at 74 years old, he's still climbing up on ladders and fixing stuff. But I grew up with this mindset of entrepreneurship was the thing you did if you couldn't get a job. And you would go and study and become a lawyer, a doctor, or an accountant, one of the professions. So for the first sort of 15, 20 years of my career, I was a chartered accountant by training. I worked in big retail bank, worked with small businesses. And then probably about 12 years ago, I joined a startup business that was doing financial inclusion work, and actually working in sub-Saharan Africa, the likes of Kenya, Tanzania, Ghana, and working with on-the-ground entrepreneurs. And I learned more about entrepreneurship in those sort of 3 years, working with people selling, secondhand clothes at a market, about entrepreneurship, and started to shift my focus. I've always been a very purpose-driven person, and I realized actually, the stigma of entrepreneurship was, not what I had growing up. And about 6 years ago, I met my current co-founder of Bizval, a guy called Howard, who was a bit of a rich dad, poor dad story. He at 60 had built 30 different businesses and was in the process of exiting one of them. And we just hit it off. And his biggest gripe was that as an entrepreneur, he never had access to, the kind of services and pragmatic advice, whether it was, business value and all of that. You go to the big four, the professional firms and that. One, it was ridiculously expensive.
Yeah.
And two, they would talk in language of accountants or lawyers or corporate financiers, not in the language of entrepreneurs. So that's kind of where the seed for Bizval started. We wanted to create a mechanism for business owners to understand the value of their business and unlock that value, whether it meant they sell it, whether it meant they transfer ownership over time, whether it meant they draw a dividend and save from it, but to really create that business into an asset that supported their lifestyle and made an impact, rather than, just the sort of nebulous thing that, oh, maybe one day I'll sell.
Yeah. So was your experience then that a lot of owners did have that very long gap, or there was no gap actually? They never got the business valued until such time as they thought they were going to sell. Is that that?
Absolutely. I mean, that's spot on. I mean, they I think people have this business and they think one day they're going to sell it. And I know certainly in South Africa and I know in Australia, it's probably a similar challenge. The kids have gone off to the US or to the UK or some other parts of the world. So that natural succession of, hey, my kids will take over the family business doesn't always exist, or the world's changed, and the kids don't want to be running an engineering shop in Melbourne. They want to be doing, I don't know, YouTube influencer. But the point is, yes, that's often the case. And business owners often realize way too late that they've left it too late. Selling a business is not like putting your car on, eBay or the internet to sell it. It takes time, it takes preparation, and it takes intention.
Yeah. Look, I think the parallel between selling a car and selling a house is it gets they're fundamentally different things when we're talking about selling a small business.
Yeah.
And the valuation of a car or a house largely would fall within I would say, a pretty narrow range. The value of a small business could be in a massive range. I reckon I often think about it, if you have a small business and you got 10 valuers to have a look at it, they're all going to come up with different values. And then if you put it in front of 10 different buyers, they're all going to come up with, wildly different valuations for it as well. So, it's, people leave, you think people leave a lot of value on the table by not truly understanding the value of their business at any point in time.
Absolutely, and I don't know if the listeners are aware. I mean, but we've done a lot of research, and you can find other research on this. Is between 85 and 95% of small businesses not only don't sell but are not sellable. So that's a really interesting problem for us, because then you say, well, look, if only 15% of businesses are sellable, why is valuation important? Well, that's precisely the point. Is your big private equity, corporate finance firms are all worrying about servicing that 15%. Okay. And within that 15%, they're looking for the gold nuggets that they can kind of get their success fees and all of that out of. What we're actually trying to look at is to look at the 85% primarily and say, look, how do you take those 85% of businesses that are not sellable, have a conversation that, they start thinking about value, and they start increasing their chances of, moving that 85% of unsellable businesses down to 60 to 50 to 40%. Now, I know that's a big vision, but I'll use a very simple analogy, is think about one's health. Again, I'll use my dad as an example. Growing up, I think he had his first cholesterol and blood sugar test when he was about 50 years old. It wasn't a thing. Okay.
Yep.
I remember going at 20 and, the doctor telling me, listen, your cholesterol's high, your blood sugar's high. And I was living a healthy life. I wasn't eating, I wasn't smoking. I wasn't drinking excessively. And I had a hereditary issue, but I could take steps 25 years ago to kind of mitigate against that. So it's a bit like that with your business, right? Is if you know what you're aiming for, in this analogy, your life expectancy, you can take steps early on to build the business, grow the business in such a way that you're not the bottleneck. And if you choose to sell, I talk about having the optionality to sell, fantastic. But if you build a business with value in mind, you invariably build it in a way that you don't fall out of love with it. You're not working, 15, 16-hour days just to keep the lights on. So that's kind of the perspective that we look at the valuation lens through.
Yeah,
To help a business value understand the valuation drivers rather than the number itself, I think is probably more important.
yeah, they're two distinctly different things, and I think it's very easy to put a number on something. It's a lot harder to actually say what drives that number. But I just want to go back to that 85%. That's a staggering number, and there's I read from time to time it's 70%, it's 80%. It's from my own experience, it's very high. If
Yeah.
it's for those that do sell, it's still a very. There are exceptional businesses that get picked off by larger competitors or private equity. So I think we're talking about more of the main street businesses, and
Mm.
but it's a frightening number. If it's 60 or 80, or all of those numbers are frightening, and it's not just
Mm.
for the owner, and it's kind of easy to put your head in the sand, but it's also a real issue for the broader economy if these businesses aren't in a position to sell. So yeah, it's where do you see, because you're working globally, you're working in different markets. Is that common across international
I
markets?
think it's a global issue. I think different countries have different approaches to things, and I'm sure we'll drill down into that a little bit later, Michael. But it's, the mindset of that entrepreneur is the same worldwide. Generally, they're a problem solver. They want to get their hands dirty, and what it takes to get a business going and what it takes to make a business valuable are often two different things. But we see the same trends the
Yeah.
world over. Obviously, certain countries, like the United States, have probably got a much higher tolerance towards, I guess, failure, and making it easy for people to start and try things. Countries like the United Kingdom or Australia tend to be a little bit more, let's call it bureaucratic or compliance focused in their approach. So,
Yeah.
there's those sort of nuances, but yeah, generally very similar trends and themes.
Mm. Yeah, I think the Americans do it well from the point of view of lending, government-backed lending for small business, which is a huge leg up over what we have here and in the UK. But to go to that, the value drivers and the value. So for an owner, the trigger is I'm going to sell. So what's it worth? What am I going to put in my pocket? Like that, I think it's not even a question of will it sell. It's how much am I going to get and when, and that's where it. So that's only one part of it. Free valuations from someone wanting just to sell your business, and that's all. You can get different kinds of valuations. Be careful who you get your valuation from. But also, let's just work with this 85%. So there's a lot of owners are going to be in their business for a lot longer than they want. And one of the things about valuation, and increasingly the work I do, is try to get back years from when an owner might want to sell to understand the business value if they had to sell it tomorrow. And it's put a line in the sand, and it's often a bit of a wake-up call. And that's a good thing if you've got a few years up your sleeve. If you're motoring along thinking I'm going to sell next week, I'm going to get X dollars, and I'm going to get it in 6 months, and I'm going to retire. You have no time then to work those value levers. So when I'd like to get your input, comments on who should you get a valuation from and why, and what are the potential issues an owner might face from getting a valuation with the wrong setup, the wrong objectives from the wrong valuer or supposed valuer.
Michael, that's a great question. I want to kind of answer this in a couple of ways. So the first one is, and I just want to deal with this, is let's call it a compliance-based valuation. So as you say, compliance-based valuation might be for tax purposes, or it might be for a deceased estate or settlement estate, and those are important. But that's not our focus from a Bizval point of view. So if you're going to do that, you need to make sure that if you're doing it for tax purposes, or you're doing it for anything where there's a risk of that you're going through a certified planner and somebody who's got those credentials. Okay. There's also, if you want to sell your business, you can get business brokers, for argument's sake. Okay. It's a bit like going to a realtor or estate agent to sell your house, right? And often those valuations are inflated. I'm not saying always, but often they are, because, they create, as a business owner, your ego gets in the way. I'm going to go with the guy who gives me the highest valuation. So you need to be very careful of those. You always have to say, how independent is the person that's doing the valuation? What vested interest do they potentially have? And the more of a vested interest in the situation, sometimes the less reliance that you can put on that.
Yeah, I think it goes even deeper than that. If the giver of the valuation, if their objective is to win the business, there is an incentive to say it's worth, without necessarily doing a whole lot of work, it's worth an amount of money that sounds attractive. And it's a trap.
And I think it's also fit for purpose. No disrespect to the big firms. I come out of a big four background. It's got to be fit for purpose. So if you go one of the big firms, often what they'll do is they will look at let's say you've got an IT business. Often the approach they take, it's very compliance based. So they have to, there's a lot of penalties and that, like professional indemnity and all that sort of stuff. But they often use
assumptions.
Howard talks about this when he got his valuation report for his business. I think he paid one of the big four something like $50,000. And he said it was 49 pages of disclaimers and 1 page of stuff that kind of made a little bit of sense, but it was referenced to listed multiples of listed companies, which actually, to be quite frank, had no relevance to his business. So, just because it's expensive doesn't necessarily mean it's good. So for small business owners, I think it's about understanding, why do you want to do this valuation? That's the first question you need to ask. And where we focus on is valuations for helping you strategically plan. Think about your business in a better way. So it's like going for that annual health check with your physician to say, like, how do I make sure that I'm going to have a long and healthy life, and not just a long and healthy life, but that when I'm 80, I can still climb the stairs and not have to worry about that. So
yes,
is it compliance? Is it for a particular
Yeah.
transaction, or is it to help you strategically plan for a better outcome? Those are kind of the three things we look at.
Yeah, and I think for the purposes of this discussion, that's what we want to do, is focus on that, getting a valuation as part of, you invest money in your business to sustain it, to do compliance, to grow it. You invest money in yourself occasionally. Sometimes people do it more than others, but to improve your leadership skills. So this is, in some ways, I see it as another operating cost or an insurance policy to ensure that for the length of time you're going to be in your business, you're working on these value levers, and it's probably a good time for you to talk about the valuation process that you go through, and then helping owners understand what a valuation lever is.
Absolutely. So I want to just talk about that. Is the first thing is, evaluation by its nature is forward looking. So let's just break it down to its key elements. Is this principle of willing buyer, willing seller exists, okay? But a willing buyer looks at something and says, well, why would I buy that? So a buyer looks at this through the lens of the risk and the returns in the business. So and the returns is, how much cash profit does this business make? And how likely is it that once I've written the check, that these cash profits are not just repeatable, but that they can grow and that they can happen with me as the new owner, not with the charismatic previous owner. So when you break it down to that essence, what happened in the past is helpful. It gives let me give a simple example. If you were a sportsman and you played sport at school and you played for the first team and you had a good training ethic and that, Well, it's likely you might be able to play cricket for your local club first 11, or maybe even make it into one of the, the sort of district teams, or whatever. Maybe one day you could make the Australian team, but it doesn't necessarily mean that you can. There's plenty of good sports school sportsmen who never make it beyond that. So it's forward looking by nature. I think there's three key things I want to drill down is, cash profits. How much cash profit does a business make? So forget about revenue. And cash profit, does talk about revenue. It's how repeatable is that revenue? So do your customers come back? How concentrated is that revenue? So do you have one big customer that if they fall away, your business is gone? Or do you have, more customers with smaller profitability? And then the unit economics around that, if you're selling it for $100 and it costs you 20, great. If you're selling it for $100 and it costs you $99, well, not so much. So the first thing is around understanding how your cash profits are made and the unit economics that drive that. The second thing is understanding, the dependency on the owner, and that's absolutely critical. I mean, this is the single biggest reason why small businesses are not sellable or don't get the value that they could, is because the owner is the business. And there's no problem with that. If you build a business where you are the owner or you're self-employed, that's fine. But don't expect to sell it for millions of dollars down the line and go sailing off into the sunset. So it's a bit of a proxy. We ask a bit of a cheeky question when we do evaluation. We said, as an owner, what happens if you take a 3-week holiday? From I can go question. I can go to Bali for 3 weeks without cell phone signal through to, so I can't take a 3-minute toilet break, and that's such a good proxy for, do you have systems? Do you have processes? Do you have those things in place? And then I guess the third one is can this business grow? So is it stagnating? Is it growing? What do those growth plans look like? How do you deliver on them? I mean, there's a multitude of things that you can look at, but those are probably three of the most important things that we look at. So we look at things like the sector that you're in, the country that you're in. Those all make a difference. But at the end of the day, it's about the fundamentals of this business. Have you built a cash generating machine that can operate without you? And that's the crux of the matter ultimately.
Yeah, I think it's what you're saying there is digging a lot deeper on the numbers than just what the accounting statements or tax returns say, which is typically pretty high level. It's done for compliance, those returns. But they, I think most owners I've dealt with would not get a lot of pleasure or interest or value from those accounts because they don't really tell a story. And what you're saying here is that you've got to dig deeper, and that's part of the process to really get a valuation that is credible and can help you change the way the business operates. You've got to dig a lot deeper than.
Yeah, I mean, just to elaborate on that, and I'm an accountant myself by training, and often people will say, I'm going to go to my accountant, they'll give me a valuation. Now, that's well and good, but most accountants, so there are exceptions, are compliance-based by nature. As you say, they're making sure that you file your tax returns on time, that your payroll is done, and that you've got a good set of accounts. They're not trained to think like an entrepreneur in terms of how do you generate cash. The good ones will do that. But also I think, in a lot of jurisdictions, I think Australia in particular, there's a heavy duty of compliance and duty of care in that on accountants to stick to their lane and just do what they do well. So it's sometimes a very difficult sort of bridge to cross for an accountant to say, I'm going to become an advisor. It's easy to say, great, I'm going to become an advisor. But, I can host a podcast and you can host a podcast, but, quite frankly, neither of us are, what's a Joe Rogan or one of those guys, they just take it to the next level, right? So I think it's about understanding some of those dynamics. And surely your accountant needs to understand these things, but they may not always be the best person to help you, take it to the next level.
Well, they could be. It could be for two reasons. One is it's a highly specialized profession or practice to prepare and sell a business, to go through what you need to go through, and you can't do that on an hourly rate basis for a start.
Yeah.
So that's and also I think there's a lot of potential conflicts there in terms of saying to your existing client, that's why I think they usually give them these wide ranges.
Yeah.
Rather than saying, it's not actually worth what you think it's worth. It would be hard to say to a long-standing client, even if you did know a lot about the business and about the valuation and business sale process, that your business after 25 or 30 years is probably only going to get a certain amount of money that I knowing you well is going to disappoint you. So it's a conflict there, and I think that's we do have a regime where there's a lot of compliance and expectations on advisors. So I think that's increasingly why we're all better to use other experts to do the things that we all do expertly.
Yeah, and that independence that you touch on is absolutely critical. It's kind of one of the reasons why doctors aren't allowed to see their own family as patients, right?
Yeah.
It's really a tricky one. We have a saying in our business that we always tell the client what they need to hear, not what they want to hear, and sometimes that's a very difficult message to deliver, because as a business owner or entrepreneur, you kind of have effort reward bias. So it's like, I've worked so hard on this thing, it must be worth a lot. And then when they hear that they're not going to be cashing out their $10 million, it's closer to $1 million, to give an example. There's this like, I don't believe you kind of reaction, and you need to be prepared for that, and you need to be able to deliver that kind of news with facts that you can say, this is why I don't believe it. And also, this is what you can do if you're prepared to put the time and energy and investment to get to a more suitable outcome.
Yeah, and it's the time thing we've come back to a number of times already in this discussion. And years out from a sale, you have the ability to do something about it. You're doing valuations across the globe with small businesses. We'll get to that particular process a bit later, and some of the process that you go through, which I think is really high quality and valuable, more so than just that sort of valuation that looks at the numbers and says, well, should be worth 2.5 times earnings or whatever, and without really digging too deep. But I get asked a lot of times, give me a broad brush or a rule of thumb or a bit of an indication of what my small business is worth. And I say it's, for the average small business, the valuation would go something like 1 times up to 5 times adjusted annual profits if you want a start point. And that is you can see how insanely that from if your business is valued on a multiple of 5 and you're making 200,000, you've got $1 million business. If your business is valued for whatever reasons at a 1 times multiple, 200,000. So that it's and like that is an enormous range. Firstly, is that I've come to understand that there's a whole lot of reasons why that range sits where it does underneath public equities, which trade for more like 8, 10, 15 times earnings.
Yeah.
So there's a home for small business right at the bottom end of multiples.
Yeah.
Is that a range that's valid in other markets, other geographies?
Yeah, Mike, if I can just break that question down into a few areas. Okay, the first one I want to talk about, that what we call multiples. Okay, and I just want to elaborate on this point. Using a multiple is a useful sense check. Okay. But I always caution against this. It's an output measure or a sense check measure rather than a core approach to valuation. Okay. So it's a bit like putting, five, 1.9 meter tall men that all weigh 120 kilograms in a row and saying, okay, great, they're all going to play, rugby football or, or rugby union for Australia in the front row. Okay. So that's what a multiple is. So you've got to be very, very careful. And
in everyday language, because a lot of that chat about how to value a business still, I'd say a lot of owners would be at least broadly familiar with the multiple, and I would say to them, it's the number of years of profits you're willing to pay.
Yeah.
Today, and if But anyway, yes. So your approach is.
So let me break that. So I take a step back from that. You say, okay, well, if that's the output measure, what's the input measure? Okay, and then you've got two types of buyers. Typically, you've got a financial buyer, and you've got a strategic buyer. Now, strategic buyers buying your business because there's some synergy for them, okay, that they can leverage. And everybody's like, I'm going to get a strategic buyer and I'm going to get a 10, 15 times multiple. Let me just park that for a second. Strategic buyers do happen, but it's a bit like the talent scout happening to walk past your house and seeing you play a great cover drive. And they're like, oh, Michael, even at your age, come and play cricket for Australia. It happened. I'm dramatizing for effect, but it happens, but it's not the norm. 90% of the time, it's going to be a financial buyer or somebody who's investing money in your business. So the way those multiples work, it's a function of how much liquidity is available in the market is one. So a listed company versus a private company. A listed company is on a stock exchange. You can buy and sell easy. So there's a lot of liquidity in the market.
You can get your money out tomorrow. Yeah.
Absolutely. Yeah. Okay. In small businesses, that liquidity doesn't exist. So there's a lot more risk. Yep. Even if you've got a good business, if you can't access that. So it's a function of risk and return. Now, how do you get, that range of saying, when we're talking small businesses, I'm talking businesses in the, let's call it, 2 million to 30 million, let's for today's podcast, say Australian dollars range. Okay.
Yep.
It's quite interesting because you go to the US, it's probably a similar range, but with a better currency. Okay. But an investor looks at that and says, look, I want to generate X return. And for argument's sake, most small businesses in an economy like Australia or the US or a developed economy, that return would probably be, required rate of return would be between, anywhere between 18 and 25%, depending on how old the business is, stage of business. So effectively, if you're going to be generating a 25% return on this business, you work backwards. Okay. And the return is based on how much you're paying for it, and how much normalized, as you say, adjusted cash profits. So people use terms like EBITDA and all these things. Let's just keep it simple. How much cash profit does your business make? And for a buyer, they're going to want to make sure that that's cash profit after you've paid the owner or the operator a fair market salary, and you've normalized that for the basic normalizations. I've seen people extend that definition to like the nth degree, but we're quite pragmatic about that. And then you say, well, if I'm going to need to get a 25% return, these are my cash profits. You can work backwards to find out what that value is. And it happens to be between, let's say, globally 2 to 4 times for businesses of this size. A really good business might get 6 times. Okay, a really bad business might get 1 times or 0 times. Like it can be quite binary at the lower end. So that broad range is not helpful. You have to peek under the hood and see what is your blood cholesterol reading, what is your BMI measure, what is your blood sugar level. Just because you happen to look similar to your neighbor doesn't mean that you have the same degree of health. That's the way I look at it.
Yeah, no, agree fully, and it's good, impartial, independent perspective. That's and you've got to ask. It's like a lot of advice. You've got to ask the right people for the advice you really need, and not just be sold on something that is biased or. But that's it's the so
I mean,
we want to get.
If I may, and not to talk over you, Michael, but just to give you an example from some of our stats. So I'll give two examples. One is if you look at the age of the business. So, the longer you've been in business, often less risky, right? And then I'll also look at the degree of owner dependency. So across our data points, and we've valued thousands of businesses, if you take a business that's been going for, 3 to 5 years, the average value of business we've looked at there is $1.1 million. Okay. If we look at businesses that have been in existence for more than 10 years, normalized for the same sort of revenue and what have you, it's $2.8 million. Okay. They've had the track record, they've built systems, they've done all of that. So that's like a 2.8 times difference. The first one is trading on a 2 times multiple, the next one's on a 5 times. And then owner dependence is another big one, so it's even more stark, so highly owner dependent businesses, our average value is sitting at like $300,000. And then limited owner dependencies up at like $2.6 million. So, that's almost a 8 times difference in terms of price. So those, the sensitivities are a lot bigger than people realize.
Yeah. Oh, look, with owner dependency, it's the single biggest issue in the transition or otherwise of a small business. And there's only, and a lot of them are. And a lot of them, if properly set up, can start to diffuse or reduce that owner dependence. And what you're saying is it parlays straight to to a high value, because it's easier for a buyer they're prepared to take more of a risk on it because there's less owner dependence.
Yeah, and often owners are their own worst enemies often, because sometimes it's not a financial or a systems or a process issue. It's an emotional issue. And those, I guess that becomes harder to deal with. And I know you spend a lot of time working with owners and that, helping them navigate the emotional complexities of that, So it's not a binary ones and zeros. It's often a little bit more nuanced than that.
Well, it's the glory of working with small business, because there are all these owners who have their own reasons for being in business, and it's got to be financially stable. Some owners are in it purely to crank out the most amount of money. A lot of them are in it for a mixture of personal and financial. And there are others who are in it purely for the personal. But that's the wonderful thing about trying to work with those owners and get them to a point where they're making conscious decisions, because at some point they do. There's a age or illness or external events happen to them, and they've been rolling along and they're happy with the way it's gone. Yeah. And all of a sudden something's going to change. So then it goes to, well, I've got to look after my dependents, or I do want to look after the staff. So yeah, that does change. But it's.
Just to jump in there, you touch on a really important point. Is those external events, unfortunately, happen unexpectedly, right? And it's too late then, sadly, but you can also take steps to mitigate against that, So there are things like, life insurance, disability insurance policies, key man insurance, all these things. And, it's a good idea to have those things in place. Buy-sell agreements, right? And that's another area where knowing the value of your business is important. Are you underinsured, or are you, because, if you don't have the right insurance in place, it doesn't cover you. And it's a very pragmatic thing that a lot of business owners do, is they put the insurance in place and they understand that it does provide them with a degree of protection. Not entirely, but it's something that you should think about.
For sure. What if globally, where do you draw your data from? I'm interested if you're happy to share a little bit about that. It seems like it's not dissimilar in the US, UK, and other bigger markets like that. Is that something you're happy to just talk about briefly?
Yeah, so the first thing I'd say is we actually, one of our ambitions is to build. These data sets are limited in terms of private data. and there's a lot of noise in the data. So one of our ambitions is to, via Bizval, actually build a global data set for small and medium businesses that becomes a credible, unbiased source of data. So it's not just deal data and sale data, it's across the spectrum. Okay, so I don't want to say that arrogantly, but that's part of our stated ambition, is to build that. So we collect data with a lot of our partners, accountants, fractional CFOs, all our integration partners. So we collect a lot of data ourselves. Having said that, though, I mean, we've been going for 3.5 years. We've done extensive research across, whether it's PwC reports, each of the markets you can go. I'll mention a couple of them. There's guys like Mark to Market in the UK. In the US, there's like deal leader data where you can actually, find this information. So we've used a lot of that to ground truth our starting assumptions. But it is a real challenge to find that credible data. And that's one of the things we're trying to address with what we're doing. And we will get there.
Yeah. Look, it's incredibly hard to come up with credible sources of like businesses sold for this or that. It's and it's one that, as a practicing business valuer, it's a real battle for me every time you look at a valuation. Fortunately, there's pockets of data, but it's pretty hard to crack, and it's why be careful be careful where you get that or who you use it from, that data, because we've already, whatever the range is, there's this enormous spread of potential value which is won or lost because of a few things. One of them is not understanding where you sit on, in terms of value today, and then if you do go through an exhaustive process, where you might get that value to in a couple of years or 5 years if you do some really important work to change the way the business operates. So it's
I think Michael, that's a great point. I mean, one of the things I just want to touch on there is that even nowadays people are quick to jump to AI or ChatGPT and go get a number, and it's one of the reasons why we as a business, whether it's a 5-minute quick check valuation or a more sort of typical 3 to 5 day engagement, we always have a human set of eyeballs interrogating the inputs and the outputs and making sure that they make sense, whether it's via an email or a Zoom call. It might sound, how do you do that at scale? But it's something that we've entrenched in our process, is to have that human review every single time. So it also provides a protection against just questioning some of those inputs, and do they make sense? Because it happens often. People will slip a 0 year or conveniently change the growth rate, and having that quality control is essential.
Hey, just how do you do your valuations? Where does it start for a potential client wanting to find out? Do they? Just talk us through that.
So I'm going to talk just our approach. We've got 2 basic products. One is an online platform that's delivered on a Zoom online call, so you can do it anywhere in the world, and it takes between 45 to 60 minutes. And the other is the more traditional approach that you would go through with your, valuer, which can take 3 to 5 days. But in essence, what we do is we get your recent financials. You don't even need those. We break it down into a few components. Understanding the business. How long have you been in existence for? Which sector, which country, all of those things. So that's the first section. And it's designed as a conversation like we're having now with a business owner. Then we have a section on how do you make money. Okay. So we could go and upload 5 years worth of income statements from zero or whatever it is you're using. But we have a conversation. What's your revenue? What are your costs of sales? What are you paying yourself as the owner? What's a fair market rate? What percentage of your income comes from your 3 biggest clients? So we go through and we reconstruct that normalized income statement. We then look at how you manage your cash flow. So do you have any excess cash that's sitting in an investment account somewhere? Do you have any property? How do you pay your suppliers, and how quickly do you? So we work out your working capital, so how cash flows in and out the business. We then look at your balance sheet. So what equipment do you have? What debts do you have? And we factor that in. You know, I'll use a very quick example. A manufacturing business that is underutilized might have, you know, $10 million worth of equipment that from an accounting point of view has been fully depreciated, so there's no charge coming through the income statement. We would make an adjustment for that because at some point you've got to replace that equipment.
Yeah.
And then the last thing we do essentially is we understand stage of business, growth prospects, things like owner dependency. So what do you expect you're going to grow at over the next year, the next 5 years? And essentially what we do is we take all that input, we build out a 5-year cash flow income statement for that business. And then what we do is we do a discounted cash flow on that.
Yep.
We then
Yep.
do reference multiples. So as I said, we use that as a sense check rather than the core way of doing it. And we look at the accounting value. What's the difference between your assets and liabilities? And depending on, you know, your business and where you're at, you know, the weightings and that of that differ. And then you get your value, which is a composite of those three things. More importantly is once you've done that, you can see what does the 5-year plan look like that you need to actually deliver that particular value. And you might look at that and say, oh, that's impossible. Okay. Or you might say, oh, that's a breeze. Okay. And then the last thing we do is we allow you to run different scenarios to say, well, you know, what happens if I had to spend an extra $100,000 on getting a 2IC to come and run the business? But because of that, you know what, I can now take a 3-week holiday and be available to my team rather than I can't take a 3-day holiday. So that's actually what's really important for us is that you can run those different sensitivities to say, what if? You know, so that in a nutshell is how we think about valuation and, you know, how much background information we check and how many years of income statements that will vary depending on the product that you use with us.
It's interesting. It sounds a lot like you start at that high level of the industry and some of the broader things which have a massive influence on any one particular business. And I think the concept of discounted cash flow, if you any valuation that you do, regardless of, you're really trying to take a stab in the dark at what are the profits going forward. That's the purpose of. So what I really like, and I don't, in business broking, in small business, at least in Australia, the use of forward cash flows is sometimes done by the buyer, but not very often done by the seller. And I think that's how many times have I heard, oh, it's too hard to forecast. Yes, but if it's too hard to forecast, you're really up against it to start with, because that's what a buyer's buying.
That's what a buyer's going to do. Yeah, so you're going to put yourselves in their shoes, not in your shoes. You know, they're unemotional about it, to be quite frank.
Yeah, and then it's like, then you start to really, then an owner, I think it can be a real moment when you start to force them to think about the future, force them to think about the assumptions that go into that model. What is my unit price? How many of them am I going to sell? And then it's illuminating, because it's the point where you start to think less about what's happening right today, and more about, which is one of the reasons to loop this all around is, you know, to get an invasive, intensive valuation like that, to really push yourself to think about where the business is going to head, is a really good investment, because as much as you might want to sell, you're going to be running that business for a while yet. And if you can get more out of it while you own it, well, that's a good investment as far as I can see.
Absolutely.
All right. I'm conscious of time, and I've got a couple of things I wanted to ask you about. I I was going to ask a giggle question. Like, have you been in a situation where you've been in a transaction, buyer comes along and says business is worth $1, and the seller's saying no, it's worth 15, and just $1 million versus 5 million. I've seen a lot of these ridiculous like sword fight between insanely different valuations. What's the worst you've seen, or the biggest
Yeah, I
gap
mean,
between them?
I've seen that. I've seen one where the buyers like I think they call them in the UK £1 Charlies. But look, most legitimate buyers, as you say, take that forward forecasting view, and they say, well, what am I going to get on my return? But I kind of seen like an 80% difference before. So let's call it $2 million versus $10 million. I've seen that kind of range of difference.
Yeah, yeah,
Um, you know,
yeah,
in that instance, it was actually a seller with an unrealistic expectation.
yeah,
The true value was around about $4 million, and that's where the deal actually got done. And the way it was structured, that's why we look at these different methodologies. If we looked in the rearview mirror, it was $2 million, on a multiple.
yeah,
And there was some upside. And the way that got structured was the valuation was agreed at $4 million. $2 million was paid cash upfront, and the other $2 million was based on an earnout to say, stick around for the next 2 years, prove that you can deliver those results, and it was paid out. So
yeah,
often when you get those gaps, it's a question of deal structure rather than value. So if you can agree on the value, what does the owner need to do to stick around to make sure? And if you want a clean exit, get exit ready beforehand. If you're
yeah,
prepared to
yeah.
stick
That's right.
around with a new owner and a new boss,
Yeah,
then you can have an
and
earnout.
and don't waste time with a ridiculous number. That's
Yeah,
this idea of floating a number to see what's out
doesn't
there.
work.
You just waste time. If this is the final question, if you were plucked from where you are right now to come and run Australia's federal small business department and bring all that international expertise, what are some of the things you might recommend our current Prime Minister to do to make our SME economy more resilient and more successful?
So I knew this question was coming, but I'm not going to do an Elon Musk here and, and throw a bomb. But I would say there's three things. If I look globally, I think we touched on the first one earlier. One of the things that the US has done really well is what they call the Small Business Administration loan, in my opinion, is how do you create liquidity for people to buy small businesses? Just a very interesting stat quickly is globally about 10 to 15% of household wealth is kind of in small businesses. And it tends to be higher in more developing countries because there's a lot more informal economy and what have you. In Australia, that number sits between, depending on who you ask, between sort of 2 and 3%. Okay, so in Australia, the contribution from small businesses is actually a lot smaller than other economies. The highest I've seen in a sort of a developed economy is Germany, which sits at about 14 to 15%. So I just want to give that as a range.
Is that
But
as in terms of the average wealth of a average family? Is that yeah, yeah?
yeah,
I think
so
I,
so
I
so
think
so,
I
so
shared that
funding and
article.
liquidity is critical.
Yeah,
And then I think the red tape, remove the red tape. When it comes to things like setting up a business, tax compliance, VAT compliance, all of that sort of stuff. You've got to make this as easy as possible for entrepreneurs to start a business. Okay. And the consequences for failure, I'm not saying you need to take away, the implications of bankruptcy and all of that sort of stuff, but you've got to remove the red tape and you've got to create an environment that allows people to take a chance. It's a bit like, I'll use a cricket example very quickly. Why is 2020 cricket so successful? Batsmen come in and they take a swing. Okay. In a 5-day match, gone are the days of, I'll use South African Kepler Wessels who used to play for Australia, batting at like 1 run and over for 3 days. I mean, it's you're not playing forward defensive. You're playing go for sixes. Okay. So,
yeah,
so remove
yeah,
the red tape and make it easy.
yeah,
And number three, I think Australians, and this is one benefit living in South Africa that I've got, is you have to understand that South Africa, that Australia is a fairly small market. Okay, it. So when I look at the US, they've got a big domestic market. So I think, if you really want to drive small businesses, you've got to make it easy for them to do business internationally, to access markets outside of Australia, whether that's, Japan, United States, the UK. So those are the three things I would look at: is how do you create funding? How do you remove the red tape? And how do you give access to international markets to ordinary Australian business people?
Yeah, good one. No, I really appreciate that you're taking time to think those through, Graham. It's that one of percentage of ownership. I think I shared with you an article I wrote where the business equity on the balance sheet of the average Australian family is nowhere. It sits below furniture, fridges, and flat screens. And so this whole conversation is about compelling or getting some intrigue about for owners about what my business is worth tomorrow, regardless of what you're intending to do in a week or a year or 5 years. You need to know that, and you need to know it from a credible source, so they can check you out, and it's all a part of, at a higher level, of seeing the real value. And you said it's up to 15% in Germany. That makes sense to me. They'll probably lend to them. They probably have a much easier system to get the businesses up and running, and so on and so on. So yeah, all power to you, Graham. Thanks so much for your time this evening, and for you, whatever it is, wherever you are. I think you're in the morning. Thanks so much for your time. Where does someone go to find out some more about Graham Stephen or about Bizval Global?
Yeah, so thanks, Michael. It's been an absolute pleasure. But I would say probably three things. You can go to our website, www.bizvalglobal.com. You can email me. That's Graham, Graham, at bizvalglobal.com. Or you can find me on LinkedIn, Graham space Stephen with a PH and an EN. So, but yeah, it's been wonderful to chat, and hope to have you on our podcast soon, Michael.
Yeah, I'd love to come along and chat whenever the opportunity is there. But I really do appreciate digging deep on a really vital topic for small business. Thank you, Graham.
Fantastic. Thank you.